So imagine a huge company takes out a massive loan. We're talking billions to build something epic like a new factory or a power plant. They're paying a ton in interest, right? But where does that cost actually go on their books? Is it just another bill they pay, or is it something more? Well, today we're diving into the official rulebook that answers that exact question, IAS 23, borrowing costs. We're going to find out when interest is just a regular expense and when it actually becomes part of the asset itself.
Here's how we're going to break it down. First, we'll tackle that big choice. Is interest an expense or an asset? Then we'll get into what kind of project even qualifies for this special treatment. After that, we'll look at the timeline, which I like to call the capitalization clock. Then, of course, we'll crunch the numbers, and finally, we'll cover what companies have to tell all of us about what they're doing.
All right, let's jump right in with that fundamental question. To make this feel real, let's invent a company. We'll call it Future Gen Power. And they're building a massive, state-of-the-art wind farm. This isn't a weekend project. We're talking a huge, multi-year undertaking.
So to get this thing built, FutureGen borrows $500 million. Now, every single month, a huge interest payment is due. So the big question for their accountants is, what do we do with this cost? Is it just a business expense for this month, or is it actually part of the cost of building that wind farm? You know, this one decision leads to two totally different worlds. They could treat it as an immediate expense, which hits their profits right now and makes them look a little less profitable. Or they can treat it as part of the asset's cost. And if they do that, the very same interest payment actually increases the value of the wind farm on their balance sheet. All of a sudden, it's not just a bill, it's part of a long-term investment.
So which way do they go? Well, thankfully, accountants don't just have to flip a coin. The answer is laid out for them in International Accounting Standard 23.
And here it is, the core principle. Now, in accounting lingo, turning an expense into part of an asset's cost is called capitalization. IAS 23 says you have to capitalize borrowing costs, but, and this is a big but, only if they're tied to building what's called a qualifying asset. Any other interest? That's just a regular old expense. So you see, everything hangs on that one key phrase, qualifying asset. Which naturally leads us to our next section. You can't just go around capitalizing interest on any old loan. The project itself has to fit a pretty specific definition, so let's get into the rules of the game. And here's the official definition. It really all boils down to time. A qualifying asset is something that takes a substantial period of time to get ready. Now, the standard doesn't say, 18 months or more, but the idea is clear. We are talking about major, long-term projects.
So what does that look like in the real world? Well, think big. Manufacturing plants, huge investment properties, even complex intangible assets like software that's being developed over several years. And of course, power generation facilities. Just like FutureGen's wind farm. These are all prime examples.
And what doesn't make the cut? Well, if you just buy a building that's already finished, that's out. Inventory that you crank out really quickly and in huge amounts, like a bakery making thousands of loaves of bread a day, that doesn't qualify. And financial assets are out too. It always comes back to needing that long, substantial construction period.
Okay, so let's say we've confirmed it. FutureGen's wind farm is a qualifying asset. Great. But now the accountants need to know exactly when to start adding interest to its cost, and, just as importantly, when they have to stop. You can think of it like a stopwatch that they have to manage perfectly.
The standard actually breaks this down into three phases. You've got commencement, which is when you start the clock. Then there's suspension, for times when you might need to pause it. And finally, cessation, which is when you stop it for good. Now, to start that clock, it's not enough to just have the loan. All three of these conditions have to be met at the same time. 1, the company has to be spending money on the project. 2, it has to be incurring borrowing costs, actually paying interest. And 3, activities to get the asset ready have to be underway. And that includes the boring stuff like getting permits, not just pouring concrete. So what happens if work grinds to a halt? Well, the rule is you have to pause the clock if there's an extended period where active development is suspended. Now, a short delay for bad weather probably doesn't count if that's just a normal part of the process, but if the project gets put on ice for months, yeah, you have to stop capitalizing interest during that time. And finally, when do you hit stop for good? The second that substantially all the necessary work is done. This basically means the physical construction is complete. Even if there's still some minor paperwork or decorating left to do, if that asset is pretty much ready to be used, the capitalization has to stop. So, we know what qualifies, and we've got the timeline down. Now for the fun part, the math. How does a company like FutureGen figure out the exact dollar amount of interest to add to that wind farm's cost? Well, it all depends on where the money came from.
There are really two main scenarios here. The simple one is specific borrowings. That's where FutureGen took out that $500 million loan just for the wind farm. In that case, they just take the actual interest they paid. Now, if they earned any interest by parking that cash in a bank account before they spent it, they do have to subtract that income. The second scenario, and this is probably more common, is general borrowings. This is where a big company just uses money from its general pool of debt, not one specific loan. Here the math's a bit trickier. They have to calculate an average borrowing rate and then apply that rate to the money they spent on the project. And that average rate has a special name, the capitalization rate.
So what exactly is this capitalization rate? The easiest way to think about it is as the company's average interest rate. Let's say they have one loan at 4% and another, bigger one at 6%. Their average cost of borrowing is going to be somewhere in between, right? They calculate this weighted average, and that's the rate they use to figure out how much interest to capitalize.
All right, we're on to our last section. So, a company's gone through this whole process. They've found a qualifying asset, they've run the capitalization clock, they've done all the math. But they can't just keep all this to themselves. They have to tell investors and the public what they've done. Transparency is absolutely key.
To make sure everyone's on the same page, IAS 23 says companies have to disclose two key numbers in their financial statements. First, the total dollar amount of interest they capitalized that year. And second, if they use general borrowings, they have to spell out the capitalization rate they used. This lets investors see exactly how they got to their number.
So why does any of this matter to you and me? Because this rule directly impacts how healthy a company looks, at least on paper. By capitalizing interest, a company's assets look bigger, and its expenses look smaller while construction is happening. This can boost the reported profits in the short term, but it also means that assets starts its life with a higher price tag, which will then be depreciated for years and years to come.
It really shows you that a simple interest payment can be a really complex decision that shapes how we all see a company's performance. So the next time you see a massive skyscraper going up or a new bridge being built, maybe you'll wonder, how much of that incredible structure's value isn't just concrete and steel, but the capitalized cost of money itself?